Friends, let us talk about mergers and acquisitions. Now, mergers and acquisitions is something which is really gearing up in the present scenario. Why? Because of the competition, the increasing competition, it has become a need of the day that the companies or the banks, the financial institutions start thinking about mergers and acquisitions. In the past, we have heard about a lot of mergers and acquisitions happening in the banking sector. Now, let us understand what is the mode of growth for a company. Now, definitely the company would like to diversify, would like to grow, right? How can they grow? Basically, there are three ways in which the companies can grow. Either through formation of a new company, they can diversify by coming up with a new company, or it can be through an acquisition of an existing company, or the last but not the least, it can be through a merger with an existing company. So let us say if a company is doing good, if I want to grow, I am going to join hands, I am going to merge with that existing company. So these are the three ways in which a company can think of growing. Now the decision which has to be taken depends on the company's assessment of various factors. Now, what are the factors that are involved? Now, definitely when I am talking about growth, I am talking about expansion. In these three ways, there has to be a proper assessment which has to be done. Now, what are the assessment parameters, or what is that the companies are going to look for? They are going to check the cost that it is prepared to incur, right? Because everything is going to have a cost attached to it, right? Because when we talk about growth, there is some cost factor associated with growth. So firstly, the company has to check how much is the cost and whether they are prepared to incur that much cost, the likelihood of success that is expected, because it is not necessary that whatever strategy they adapt, whatever new growth strategy they adopt, it is going to be favorable, right? It might turn out to be unfavorable also. So they have to be prepared, they have to be ready to take that risk also. So what is the likelihood, what is the success ratio of such mode of growth? Then the third is the degree of managerial control that it requires to retain. So how much dilution of control they can accept. On that basis, they are going to decide which mode they are going to adapt, right? So if they are ready for dilution in their control, they might go for an acquisition, they might go for a merger also. Now, the corporate restructuring can be done in a variety of ways. What are the three ways, the basic three ways in which the corporate restructuring can be done? One is expansion. Now, how can I expand? In order to expand, the company can either go for an amalgamation, it can be through absorption, it can be through a tender offer, or it can be an asset acquisition. So if I want to expand, these are the various ways in which the company can expand. That is how they can restructure themselves. Their second way is contraction. Now, how they would like to contract, they would like to reduce their exposure. In order to contract, there are three different ways in which the contraction can be done. It can be either through a spin-off, right? A split-ups, an asset sale, they will like to certain portion of their assets, they might sell off, or it can be through an equity carve-out. Then it can be through a corporate restructuring can also be taken place through control, diluting the control. Now, how can that be done? It can be either going for private equity, a buyback of equity, an anti-takeover defense, or a leverage buyout. So these are the various ways in which the control can be diluted. Now friends, let us understand what is a merger. Now merger is nothing but a fusion between two or more enterprises. Now let us talk about two companies, company A and company B. If they are coming together, okay, if they are merging together, the existence of one company might totally go off, right? There will be only one company, let's say A, who is going to exist, and whatever assets and liabilities of B exist, they will be taken over by Mr. A, by the A company, right? So what is merger? Merger is basically a fusion which is between two or more enterprises, whereby the identity of one or more is lost and the result is a single enterprise. As I said, the identity of B will be totally lost and there will be only one company, that is company A which will survive, which will exist. Now what happens is merger is restricted to a case where the assets and liabilities of the companies gets vested in another company. The company which is merged losing its identity and its shareholders becoming shareholders of the other company. So whoever are the shareholders of B company will become the shareholders of A company. Whatever assets and liabilities B has will be passed on to A company. So the identity, the shareholding, everything of B will be taken over by A. That is what is a merger. Now in merger, as I said, the two firms often of about the same size. Very important is the companies who are merging, they have to be at least of the same size. They agree to go forward as a single new company rather than remain separately owned and operated. Now let's say there is A company, B company who are running the business separately. There is intense competition between the two. Why? Because they are of the same size, they are into the same business. Now since the competition is intensified, and if they want to bring down the competition, they want to have an equal share of the profits in the market, they will always love to go in for a merger. So what happens is the two firms who are of the same size are going to come together and merge. Stock of both the companies are surrendered and a new company's stock is issued in its place, right? When two or more companies consolidate by exchanging a common stock and the resulting single company that replaces the old companies, the consolidation is described as merger. Now what happens is A and B, they had separate shareholdings, right? Now there is a new company, let's say C, that has come into the existence, okay? Now the A company shareholders will also get C shares. B company will also, the shareholders of B company will also get the shares of C company, right? And now the existence of A and B is no more, and there is only C, which is a merged entity, right? So merger usually evaporates the previous shareholding and a totally new company comes into existence. The shareholders of the old companies receive prorated shares in the new company. On a prorated basis, there is always a valuation done on the basis of which valuation of assets of these companies are done, and then we decide what will be the pro rata basis in which the exchange of shares going to take place. The merger is typically a tax-free transaction, meaning that the shareholders owe no capital gain or lost taxes on the stock that is being exchanged, right? So it is purely a tax-free transaction, and that is beneficial to the shareholders. Another concept of mergers is acquisition. Now what is the basic difference? In acquisition, it is nothing but a takeover, buying of one company that is the target by another. So the target company is being taken over by another company, which is called as an acquisition, acquiring, okay? In acquisition, one company purchases or takes over the assets of another. As I told you earlier, one company is going to take over all the assets from the other company. The acquiring company continues to function and the acquired company ceases to exist. In case of acquisition, as we said, there were two companies. A has acquired all the shares of B, and that's the reason now B is no more in existence and only A company is existing. Shareholders of the acquired company receive shares in the new company in exchange for their old shares. The term acquisition has not been defined under the Companies Act. However, the term acquirer and the control has been defined under the Takeover Code. So, though there is no proper definition about acquisition which is covered in the Companies Act, but there is a Takeover Code which defines who is going to be an acquirer and who is going to be, and what is the control that the acquirer is going to get. Takeover is a business strategy of acquiring control over the management of the target company, either directly or indirectly. The motive of the acquirer is to gain control over the board of directors of the target company for synergy in decision making. So if I want to increase the synergy, I want to increase the decision making power in my hand, what will I do is I will take over the control from the management control from the board of directors, and I will take it in my hand, so that I have the decision power, I have the power to make the decisions. Acquisition, when one company takes over another and clearly establish itself as a new owner, the purchase is called an acquisition. So the process of acquiring is acquiring of the business of one company by the other is called as acquisition. From a legal point of view, the buyer swallows the business. So what actually is happening is the buyer, the acquirer is going to swallow the business of the target, and the buyer's stock continues to be traded. So the buyer is, the acquiring company is going to exist, whereas the target company who has been acquired by the acquiring company is no more in existence. A corporate action in which a company buys most, if not all, of the target company's ownership stakes in order to assume control of the target firm. As I said, if I want to increase my shareholding, if I want to increase my decision making power in the management of that particular target company, I will like to add to increase my stakeholding in that particular company. Acquisitions are often made as a part of the company's growth strategy, whereby it is more beneficial to take over an existing firm's operations and niche compared to expanding on its own. Now friends, as we all know, in this environment, it's becoming difficult to do business on your own, to expand, right, to go in for a growth on its own, because the cost factor will be pretty high. In such a scenario, the best way in expanding, in growing is I take over some company which is already into that business, right? So that will help me to have a diversification. It will help me to capture a niche market. Acquisitions are often paid in cash. The acquiring company's stocks or a combination of both. As I said, it can be either by selling off all the assets in the form of cash, right? The deal takes place through cash or through stock. Now acquisition can definitely be either friendly or hostile. In the former case, the companies cooperate in negotiation. As I said, friendly acquisition, there is always a friendly way, there is always a proper negotiation that takes place between the two parties. In the latter case, the takeover target is unwilling to be bought, or the target's board has no prior knowledge of the offer. So it is something hostile, wherein they are forced to get into that takeover. In a friendly takeover, a public offer of stock or cash is made by the acquiring firm, and the board of the target firm will publicly approve the buyout terms, which may yet be subject to shareholder or regulatory approval. So before they approve the takeover, right, before the management decides that yes, we are going in for a friendly takeover, they need to have a proper approval taken from the shareholders, the existing shareholders of the target company, and the regulatory body. This stands in contrast to a hostile takeover, where the company being acquired does not approve of the buyout and fights against the acquisition. They don't want to get acquired, right? And they are fighting for their survival. But then when they don't have any other choice, they are definitely going to be acquired by the acquiring company. Acquisition usually refers to a purchase of a smaller firm by a larger one. So what happens is a big fish is going to eat away the small fish. That is what is basically acquisition all about. But however, there is a variety of acquisitions that takes place. In some cases, a smaller firm will acquire the management control of a larger firm, right? Or a longer established company and keep its name for the combined entity. This is known as reverse takeover. Now what here actually is happening is, it is happening in the reverse way. A small company is acquiring a larger company. Might be because of their goodwill, because of their company, their market presence, they are in a better position to retain their name, right, retain their goodwill in comparison to the large company. A type of merger used by the private companies to become publicly traded without resorting to any initial public offering. So if I don't want to get into the hassles of coming up with an IPO, I can best go in for an acquisition. If I am a private company, I will acquire a publicly traded company. So the basic objective of merger. Now what is the merger? The merger is taking place. There has to be an objective. What is the objective? It can be either to diversify the areas of activities. That is, if a company wants to diversify into certain other products and do some other business, then merger can be a best choice for them. If they want to achieve optimum size of business, that is economies of scale, if the company wants to expand as far as volumes are concerned, then also they can look forward for mergers. To remove certain key factors and other bottlenecks of input supplies. Now there are suppliers wherein the inputs, the raw materials are not coming in that volume, which is hampering their growth. In such a case, again, the company can think over of getting into a merger. To improve the profitability, very important. When I am talking about my survival, I want to grow in the industry, I would like to make good profits, and merger can be a best choice if I want to make good profits. To serve the customers better, because at the end of the day, the customer is the king. I need to serve him in the best of the ways. And if I want to serve my customer in the best of the ways, I want to satisfy the customer, I can also think of getting into a merger and getting into economies of scale, economies of scope, which will help me to reduce my cost and which can be passed on to my customers with better service quality. It can be to achieve economies of scale and size, internal as well as external. Then it can be to acquire assets at lower than the market price. Now if I want to go in for restructuring, right, I want to acquire certain assets from some other company, through a merger I can do it at a cheaper rate than if I have to directly go and get it through the market. Those assets, if I have to directly go and get into the market, it might be a little expensive. It can be to bring separate enterprises under single control, grow without any gestation period. So if I want to grow fast, right, I can bring two enterprises together, and these two enterprises in their synergy can grow, can expand and bring in more profits to their business. It can be either to nurse a sick unit and get tax advantage by acquiring a running concern. So this is the best way. Merger can be a better way in order to evade tax. If I want to save on tax, I will take over, I will acquire a sick unit. That will, because the losses of that sick unit can help me to get some tax benefit. So if a company has to decide for going into a merger, the decision on merger will be, for a firm desiring immediate growth and quick returns, mergers can offer an attractive opportunity, as I said earlier, as they obviate the need to start from scratch and reduce the cost of entry into an existing business. So rather than I starting from the scratch, I giving my best, I putting in a lot of capital into the business, I can acquire some business which is already existing in the market, and that can help me to grow. However, this will need to be weighted against the fact that the part of the ownership of the existing business remains with the former owners. So it is not that simple, it's not that easy to get into a merger. Why? Because if I'm thinking about expansion, I should also be ready for diluting the control. As I said earlier, if I'm getting into a merger, I'm acquiring a company, let's say, I have to be ready to sell off my stake, right? This is diluting the control of my business. Merger with an existing company will generally have the same features as an acquisition of an existing company. However, identifying the right candidate for a merger or acquisition is an art which requires sufficient care and caliber. So any Tom, Dick and Harry will not be picked up for my acquisition, for my merger. I will have to do a proper analysis. I need to study the market. I need to see the potential of the company which I am planning to acquire, and on that basis the merger decision can take place. As we said, what will be the effect of merger? Now there is one company and one company. 1 plus 1 is not going to be 2, but it is going to be 3. Why? Because there is going to be an additional value of synergy. So merger is going to bring in synergy into the business of these two companies. There are a variety of types of mergers that exist. Firstly, it's horizontal merger, it is vertical merger, it's conglomerate merger and reverse merger. Now what is vertical integration, friends? Vertical integration is internalization of crucial forward or backward activities. Now what does that vertical integration mean? Let's say I am a company. I can either go in for forward vertical integration or backward integration. What forward integration means is talking about buying a customer, right? So if I am a company, I will buy a customer, right? I will buy a customer of my company. So that is a forward vertical integration. I am trying to get into some new business, right? Or I can go in for a backward integration wherein I am buying a supplier. So the integration can take place in either of the two ways. So in case of forward integration, the best example can be Indian Rayon's acquisition of Madura Garments, right? The Madura Garments was a customer for Indian Rayons. But then what Indian Rayons did is they took over Madura Garments, their customer, as a vertical forward integration. Under vertical backward integration, as I said, it is buying a supplier. So the best example can be IBM's acquisition of Daksh, right? So they were supplying them with some ITS products and IBM took over that company. So then there is another way, that is horizontal integration. What does horizontal integration talk about? It is companies with the same business line, right? Two companies having the same business line are merging together, right? So buying a competitor is what is horizontal integration. The example is acquisition of equity stake in by the IBP by IOC. Or market extensions, that is new markets for present products. So if I want to diversify, I want to come into new products, then I can go for market extension. Now what are joint ventures, friends? Joint ventures are basically different than a merger and an acquisition. What is the basic difference between a joint venture? Joint venture is something which is nothing but a marriage of convenience, right? I am starting with a new project, right? There are two companies who want to participate into that project. Rather than exclusively taking that project in hand, they will get into a marriage, they will get into a joint venture. So this concept of complementary capabilities. So I am going to complement the two companies who are entering into the joint venture will complement each other. The need for international technology, right? Now as I said, joint venture can also be with certain objective behind it. Now if I want some international technology to come in, right? I am starting with a project, in this example Mahindra and Renault, right? They came up with a joint venture for a certain project wherein Mahindra was looking forward for international technology to be placed for that project. This is called as a joint venture. Now if, as I said, in case of a project where the cost is pretty high and one company cannot take care of the whole cost, in such a case, joint venture can be a better choice for them. When assets are difficult to be separated, different divisions saddled with the assets not needed. So if the assets cannot be separated and if one company cannot take over the assets in complete, they will definitely like to go in for a joint venture. Joint venture has lesser regulatory constraints. The regulations, the guidelines are not that stringent as far as joint ventures are concerned. That's all for this chapter. Thank you very much, friends.